The $7 trillion wipeout that they don't want you to know about in the last few days of January 2026. The global financial system went through a concentrated extinction event. In just a few hours, an estimated $6 to $7 trillion in notional market value was violently and without mercy wiped out from the precious metals sector. The speed and sheer brutality of the collapse went against all normal market rules. Gold, which had been rising in a historic parabolic rally to over $5,600 per ounce, suddenly fell into freefall, losing more than $500 in value in a single day. This was the steepest drop in gold's price since the early 1980s, a drop of about 10% to 12%. Historically, silver has been the least stable of the monetary metals, and it went through what can only be called a bloodbath. The white metal shot up to an all-time high of almost $120 per ounce. But then it fell by more than 30%, losing about $35 in a shocking intraday crash. Along with them, platinum, palladium, and copper were pulled into the void. To the average retail investor who was watching their portfolio lose money on their phone screen, it seemed like the whole point of owning precious metals had been thrown out the window. It seemed like everyone in the world had suddenly decided that inflation was over. Fiat money was great and hard assets were useless. But that's not how the modern financial system works. The truth is much more evil, mechanical, and planned. To understand how $7 trillion can disappear, you need to know something that Wall Street tries very hard to hide. The price of gold and silver on your screen is not set by people buying and selling real metal. It's based on the crazy trading of paper gold and paper silver, which is a huge, highly leveraged system of futures contracts, options, swaps, and unallocated certificates. Every year, the world needs about 4,000 to 5,000 tons of gold. However, the amount of paper gold traded on exchanges like the COMEX in New York or the OTC markets in London is 100 to 650 times more than the amount of real gold traded, depending on how volatile the market is. On a busy trading day, the derivatives market can trade hundreds of billions of dollars worth of notional gold contracts. While the physical market might only trade a few billion, the paper market is the tail, and it shakes the physical dog hard. When you buy a gold futures contract, you're not actually buying gold. You're buying a digital promise that is very high risk. Normally, you only need to put up a small amount of the contract's total value as collateral, which is called the margin. This lets hedge funds, commodity trading advisors, CTAs, and institutional speculators control huge amounts of gold with very little real money. As geopolitical tensions rose and fears of the dollar losing value reached a fever pitch in early 2026, speculators rushed into these leveraged paper contracts. They followed the trend, which pushed gold up to $5,600 and silver up to $115. The market became dangerously top-heavy because it was full of tourist investors who were highly leveraged and didn't have enough money to handle a sudden shock. This made a spring of weakness that was coiled, and the exchange itself pulled the trigger. The weaponization of margin requirements was what caused the destruction. In the middle of January, the CME Group, which runs the COMEX, quietly changed how it manages risk. They changed their margin system from one based on a fixed dollar amount to one based on a percentage. As the price of gold and silver went through the roof, the amount of money needed to hold a single contract also went through the roof. This basically put a limit on how much leverage the system could use, but the conversation didn't end there. In an amazing show of regulatory power, the CME raised margins 5 times in a row in just 9 days. They raised margins by a shocking 33% for gold and 36% for silver in the last 72 hours before the crash, which was the last chance for them to do so. This was like yelling fire in a crowded theater and then locking all the exits at the same time. A trader with a leveraged long position suddenly got a margin call from their broker. Put more money in right away, or we'll close your position. They didn't have the money because the speculative crowd was already at the end of their rope. The exchange algorithm stepped in without mercy and started automatically closing these positions. They sold futures contracts on the open market for whatever price the bids would accept. This forced selling set off a chain reaction that is the opposite of a gamma squeeze. As the price of futures fell, options traders who had sold a lot of call options during the rally were suddenly overhedged. These huge institutional dealers had to sell their long futures contracts quickly to keep their own books in order. Big groups of options positions, especially around the $5,300, $5,200, and $5,100 strike prices for gold, acted like trapdoors. Every time the price dropped below one of these levels, it set off a new wave of algorithmic selling. Stop-loss orders were triggered, which led to even more automated liquidation. The price dropped because the algorithms needed liquidity, not because physical gold was less valuable. There weren't enough buyers left with enough margin to stop the avalanche. The margin hike set off the chain reaction, but two outside factors gave the story a cover for the killing. The first was geopolitical and macroeconomic. President Donald Trump's announcement that he would nominate Kevin Warsh to replace Jerome Powell as chairman of the Federal Reserve. Markets see Warsh as a strict monetary hawk, a supply-side optimist who wants balance sheet discipline and is against open-ended quantitative easing. Just saying that he was nominated sent shockwaves through the currency markets. The U.S. dollar index, DXY, shot up sharply as traders took into account the possibility that the Fed might actually defend the currency instead of just inflating the debt away. When the dollar's value suddenly goes up a lot, it puts immediate mechanical downward pressure on gold and silver because they are priced in dollars. The speculative hot money, scared that the time of easy money was coming to an end, all ran for the exits at the same time. The second catalyst happened halfway around the world and made a strange and deadly liquidity trap. People in China were going crazy over silver, both for personal use and for businesses. Chinese investors, who were trying to get away from their own bad real estate and stock markets, put billions into funds like the UBS SDIC Silver Futures Fund. The demand was so high that the fund was trading at a crazy 36% to 64% premium over the real Shanghai Futures Exchange contracts. Chinese regulators stepped in because they knew this huge speculative bubble was a systemic risk. The Shenzhen Stock Exchange stopped trading on the SDIC Silver ETF for a full day on January 30th. This regulatory freeze had a terrible effect on global markets that no one saw coming. Chinese institutional traders and arbitrageurs were, suddenly, shut out of their own market and could then sell their local holdings to meet margin calls. They had to find liquidity elsewhere. They turned to global markets and sold off their Western vehicle holdings, like the SPDR Silver Trust, SELV, in large amounts and drove down the price of COMEX futures just to get the cash they needed. They didn't want to sell silver, so they didn't. They were selling it because it was the only thing they could get rid of that was worth money while their bank accounts were frozen. A 36% increase in margins, a hawkish Federal Reserve shock, and a Chinese liquidity freeze don't add up to a normal market correction. They add up to a $7 trillion paper wipeout. You get a mechanical liquidation event, which means that the price has nothing to do with reality. The amount of gold and silver in vaults didn't change. The shortages of goods around the world didn't just go away. The central banks kept adding to their reserves. Only the paper dreams burned. To comprehend the impetus behind this multi-trillion-dollar massacre, we must first dismantle the fallacy that the West employs a legitimate free market pricing mechanism for precious metals. The London Bullion Market Association, LBMA, and the New York COMEX are not set up to make it easy to trade physical metal. It's meant to handle, take in, and eventually stop the demand for gold by issuing synthetic derivative substitutes. This is where fractional reserve bullion banking comes in. Like a commercial bank only keeps a small amount of its customers' cash in the vault, bullion banks issue hundreds of digital claims for every physical ounce of gold they have in their heavily guarded storage facilities. The size of this leverage is the financial world's best-kept secret. In the years before the crash in 2026, the amount of paper gold traded was much higher than the amount of new physical gold mined. The COMEX keeps an eye on this systemic weakness by looking at the ratio of open interest, the total number of outstanding derivative contracts, to the registered inventory, the specific bullion that has been fully vetted, audited, and is ready to be delivered to a contract holder right away. During times of extreme speculation, this ratio has shot up to crazy levels. With more than 100 ounces of paper claims floating around in the digital ether, for every ounce of registered physical gold in the vault. This huge upside-down pyramid of paper works perfectly as long as one thing is absolutely non-negotiable. Most of the people involved must never actually ask for physical delivery. The speculators, hedge funds, and algorithmic trading desks must all be completely fine with settling their contracts in cash. They bet on which way the price will go, take their fiat profits, and move their contracts to the next month. But in early 2026, when the price of gold shot up violently toward $5,600 and the value of fiat currencies around the world fell, that basic assumption started to break down. A new group of institutional investors, scared by the growing federal debt and the use of the SWIFT system as a weapon, started standing for delivery. They didn't want the money settlement. They wanted the bars. This change in behavior was a life-threatening threat to the bullion banking syndicate. If even a small percentage of the outstanding paper claims suddenly wanted to be fulfilled in person, it would be like a catastrophic bank run for the exchanges. In just a few days, the vaults would be empty. The exchange would have to default and say force majeure, which would mean that the global pricing system for the ultimate reserve asset is a systemic illusion based only on keystrokes. To stop this end-of-the-world event from happening, the price of paper had to be kept low by force. This is where the real systemic purpose of using margin requirements as weapons comes to light. The exchange clearly went after the speculative weak hands by aggressively raising the margins, which made the cost of holding a leveraged futures contract go through the roof almost overnight. They made a textbook long squeeze happen. The goal wasn't just to cool down a hot market. The goal was to cause the paper speculators so much financial pain that they would have to sell all of their contracts, which would destroy the paper claims before they could ever be turned into requests for physical delivery. The margin increases were like a controlled demolition of the paper pyramid. When the CME Group changed their models to percentage-based scaling and added up the increases over a short period of time, they started a cascading algorithmic liquidation. The price went down because margin clerks had to sell off leveraged long positions. The price drop caused the next level of margin calls, which made even more people sell. This mechanical downward spiral took away all of the retail and speculative demand from the market, turning the capital into ash and cutting the outstanding open interest by a huge amount. Destroying the net worth of the people who held the claims stopped the threat of a physical run on the vaults. The reason is more than just keeping the exchange's physical stock safe. It's really about keeping the US dollar's psychological dominance safe. Gold is more than just a commodity. It's a currency of its own. It's the best asset that isn't fiat. When gold is quietly priced at $2,000, the dollar seems stable and the debt seems easy to handle. When gold prices rise to $5,600, it's like a loud global fire alarm going off, warning that the currency's buying power is falling. It's a very public and very embarrassing scorecard for the government's fiscal discipline and the central bank's monetary policy. If gold could be traded freely, without the huge burden of naked short selling and paper derivatives, the true price discovery would probably cause a panic among the general public. People would quickly leave the banking system and turn their falling dollars into hard assets. This would speed up the flow of money and start a hyperinflationary spiral. So, the price of gold needs to be kept in check. It needs to crash spectacularly from time to back up the story that precious metals are dangerous, unstable, and not good for a conservative portfolio. The $7 trillion loss was a psychological operation that used financial mechanics. The message sent to the public was clear: do and look for safety outside of the fiat system, or you'll be crushed. But even though Western financial news outlets used the crash as proof that the gold bull market was over, things were very different behind the scenes. The real smart money wasn't in a hurry. They were getting bigger. The central banks of the BRICS countries, China, Russia, India, and their new partners don't trade on margin. They don't buy contracts for paper futures. They buy metric tons of gold and then fly it back to their own vaults. The The huge engineered paper crash was a gift from the People's Bank of China and the Reserve Bank of India. When the COMEX algorithm sold billions of dollars worth of paper gold to meet margin calls, it made the global spot price of the real metal go down. The central banks of the East were happy to fill this fake gap. They used the artificially low prices to buy up a lot of physical gold from the global market at a big discount. Western hedge funds were being margin called and liquidated on their digital screens, while Eastern cargo planes were being loaded with real gold. There was a rare market anomaly called backwardation that showed the effects of this huge physical drain right away. In a normal, healthy market, the future price of a good is higher than the current spot price because it costs money to store and insure it over time. But right after the crash, the physical market and the paper market split apart. Even though the spot price on screens dropped, the premiums needed to actually get a physical minted bar or sovereign coin shot up. People were willing to pay huge, never-before-seen markups over the quoted paper price to get the goods right away. The market turned around and went into backwardation. This is like a financial alarm that goes off when something goes wrong. It means that the physical market is very tight, that people are hoarding physical goods, and that people are losing faith in the paper delivery system. The fractional reserve bullion system is coming to an end when the premium for physical metal is no longer connected to the paper spot price. To protect the illusion of the dollar, the Western financial establishment burned down its own speculative paper market. But by doing this, they gave their biggest geopolitical rivals a cheap way to get the very asset that will eventually take its place. The paper crash in January 2026 didn't hurt precious metals. It was the last-ditch effort of a failing fiat system to defend itself. The CME Group and the bullion banking syndicate were able to protect their immediate derivative exposure by engineering the $7 trillion margin liquidation. However, they also destroyed the remaining credibility of the Western pricing mechanism. The permanent separation of the paper price from the physical reality is something that financial historians will study for hundreds of years. People thought for a long time that a futures contract or a share in a big exchange-traded fund like GLD or SLV could be traded for a physical bar of metal. The crash showed that this was a terrible mistake. When the margin calls came in and the algorithm sold billions of dollars worth of silver, the paper price fell into the 70s. But if a factory in Asia or a wealthy family office in Dubai tried to buy a real metric ton of silver at the price shown on the screen, they would have found that it was mathematically impossible. There just wasn't any physical metal available at the manufactured paper discount. Instead, buyers were faced with huge markups, delivery delays that lasted for months, and even outright rationing from major sovereign mints and refiners. This is what backwardation is all about, a rare and very bad market condition, in which buyers are willing to pay a huge premium to get a physical asset right away instead of waiting for a cheaper promised delivery in the future. Backwardation could last for a few days in a healthy commodity market with enough supply. By early 2026, it had become the standard structure for both gold and silver. It's the clear mathematical proof of a lack of physical goods hidden by a lot of paper goods. The bullion banks can type as much as they want, but they can't get as much metal as they want. This brings us to the end of the precious metals market, the force majeure, as the BRICS countries' sovereign wealth funds and more worried industrial users keep taking the registered physical inventories out of the London and New York vaults. The inverted pyramid of paper leverage becomes mathematically impossible to keep up. Right now, the ratio of unbacked paper claims to physical ounces is completely based on the false idea that there is no limit to liquidity. But what will happen when the next crisis hits, and a lot of institutional investors decide to stand for physical delivery instead of selling their paper contracts in a panic? The exchanges will stop working. The COMEX and the LBMA do and have enough physical metal to meet even a small part of their derivative obligations. When the vault is really empty, the exchange will use the force majeure clause that is hidden deep in their rulebooks. They'll stop trading, call an emergency, and force everyone who has an outstanding paper contract to pay in cash, specifically in fiat dollars that are losing value at the last quoted price of paper that was artificially low. You won't get your metal if you have a silver futures contract, an unallocated bullion account at a big commercial bank, or a share in an ETF that is based on derivatives. You'll get a digital deposit of real money, even though that money is about to go through a hyperinflationary spiral. As soon as the ship goes under, you'll be locked out of the lifeboat. In the meantime, the real price of gold and silver will quickly separate from the dead paper exchange, rising by thousands of % in private physical transactions. This is why the way you own things is the only thing that matters for the 2026 financial reset's survival strategy. The argument over paper gold and real gold is no longer just about storage costs. You have to choose between terrible counterparty risk and real financial freedom. 1. The move to physical custody. You need to get rid of all counterparty risk from your precious metals portfolio if you want to survive the coming uncoupling. You have to give up the ease of using a brokerage screen for the peace of mind that comes with owning something. This means getting gold and silver coins that were made by a government, like American Eagles, Canadian Maple Leafs, or South African Krugerrands, as well as investment-grade bars, and keeping them yourself. If you have more money than you can safely keep in a home safe, you need to use private, allocated, and segregated vaulting facilities that are completely separate from the regular commercial banking system. Your specific bars are legally yours in an allocated and segregated vault. They can't be leased, rehypothecated, or taken to pay the vault operator's debts in a bankruptcy. You don't own it if you don't have it or the direct, unencumbered legal title to the bar's specific serial number. 2. The uneven silver opportunity. While central banks stockpile gold to make up for huge trade deficits with other countries, individual investors need to pay close attention to the huge supply-demand imbalance in the silver market. The global shift to green energy has a weak point in silver. It is the most conductive element on Earth, which makes it the only thing that can be used to make solar photovoltaics, electric vehicles, and advanced military electronics. The world is currently running a huge structural annual deficit in silver, using up hundreds of millions of ounces, more than the mining industry can pull out of the ground. People use industrial silver, but they keep gold in vaults. It is sprayed on circuit boards and layered into solar panels in amounts that are too small to be worth recycling. It's gone for good. The paper crash of early 2026 let institutional smart money buy this important strategic resource at prices that were not real. The industrial panic to get real silver will push the real price up by many times its current level as the paper illusion inevitably breaks down. It's the best asymmetrical hedge, a metal that is both a valuable commodity and an industrial need that can't be replaced. 3. The pivot in geopolitics. Finally, your investment plan needs to take into account the fact that the world is now a multipolar one. The Global South learned a permanent lesson when the SWIFT system was turned into a weapon and sovereign reserves were frozen. Fiat currency held in Western institutions is a geopolitical hostage. China, India, and the rest of the BRICS alliance are aggressively collecting physical gold. This is the first step in building a new, decentralized trading network backed by commodities. When the Enbridge ledger or a similar BRICS settlement system is fully up and running, they'll need a neutral reserve asset to fix trade imbalances. The U.S. Treasury bond won't be that asset. It will be real gold. When global trade moves away from the petrodollar and toward a system backed by gold or weighted by commodities, the fiat currencies of the heavily indebted Western countries will lose a lot of their buying power. The $7 trillion loss of the paper metals market was a terrifying example of algorithmic violence, but it also gave us a clear picture of what was going on. It showed that the old financial system will easily destroy its own markets to keep the illusion of its money. It showed that the price you see on your brokerage screen is a made-up number. And most importantly, it showed that the smartest, richest, and most powerful governments on Earth are using that lie to quietly build up the physical foundation of the next financial system. It's no longer safe to believe in digital promises. The time of real things has come. The vaults are emptying, the metal is moving east, and the mathematical clock on the fiat dollar is counting down to zero. The only thing left to ask is whether you have a digital IOU from a bankrupt exchange or a real asset that has survived the fall of every empire in history.